According to the Silver Institute's preliminary report released, global silver supply fell short of industrial demand by an estimated 315 million ounces during the calendar year. That's not a projection or a model. That's documented consumption exceeding documented production by nearly 20% of total annual mine output. Market analysts tracking commodity supply-demand dynamics immediately recognize this pattern. It's appeared before in recorded history, and when physical deficits of this magnitude persist, price movements have historically followed predictable trajectories. Before we examine this pattern in detail, I need to be clear about something important. This video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. What I'm presenting today is an analytical framework for understanding how supply-demand imbalances have historically resolved themselves in commodity markets. We're going to examine the mathematics behind why some prominent investors, including Robert Kiyosaki, are projecting silver could reach $200 per ounce during this cycle. Let me emphasize, this is pattern analysis based on historical precedent, not investment advice or price prediction. Commodity market researchers have developed what I call the Industrial Deficit Resolution Framework. This isn't a crystal ball or a guaranteed outcome predictor. It's an analytical tool for studying how markets have historically responded when industrial consumption persistently exceeds available supply. The framework has 4 observable stages that appear repeatedly across different commodities and time periods. Understanding these stages helps us contextualize current conditions without assuming identical outcomes. The first stage typically begins with what analysts call the silent accumulation phase. During this period, industrial demand gradually exceeds mine production, but existing above-ground inventories mask the deficit. Prices remain relatively stable because visible stockpiles at exchanges like the COMEX show adequate supply. Market participants operate under the assumption that inventory drawdowns are temporary. This phase can persist for years, sometimes a decade or longer, depending on how large initial stockpiles were. Historical examples include copper in the early 2000s and platinum in the 1990s. The second stage emerges when analysts call it inventory recognition. Market participants begin noticing that exchange-registered inventories are declining persistently rather than cyclically. Industry reports start documenting supply tightness. Refiners mention longer delivery times. This stage typically sees initial price appreciation as early positioned investors accumulate physical metal while it remains relatively available. Volatility increases but remains manageable. The third stage represents price discovery acceleration. At this point, inventories have drawn down to levels where supply concerns become mainstream. Industrial buyers who previously operated on just-in-time inventory systems begin competing for available supply. Financial investors recognize the supply-demand imbalance and enter the market. Prices can move dramatically during this stage because relatively small amounts of additional demand encounter genuinely constrained supply. The fourth stage historically involves resolution through demand destruction or supply response. Eventually, elevated prices either reduce industrial consumption as manufacturers substitute alternative materials, or high prices incentivize enough new mine production to rebalance the market. This final stage can take years to fully materialize because opening new mines requires substantial time and capital investment. Now let's examine a historical case where this pattern played out in documented detail, the copper market from 2003 through 2011. According to International Copper Study Group data, global copper consumption began exceeding mine production in 2004. The deficit that year reached approximately 200,000 metric tons. Importantly, copper prices remained relatively subdued through most of 2004, trading around $3,000 per metric ton, because existing warehouse stocks at the London Metal Exchange still totaled over 500,000 tons. Market participants viewed the deficit as temporary, expecting either demand to moderate or supply to increase. That assumption proved incorrect. The deficit persisted through 2005, 2006, and 2007. According to the ICSG, cumulative deficits over that 4-year period exceeded 800,000 metric tons. Meanwhile, LME copper inventories declined steadily, falling below 200,000 tons by late 2006. This represented the inventory recognition stage. Prices began responding, climbing from $3,000 per ton in early 2004 to over $8,000 per ton by May 2006. Industrial buyers initially continued purchasing, assuming prices would normalize. The price discovery acceleration stage arrived in 2007 through early 2008. With inventories at critically low levels relative to global consumption, and with China's infrastructure boom driving unprecedented demand, copper prices surged past $8,000 per ton. Contemporary observers noted that relatively small purchase orders could move prices significantly because available supply had become genuinely constrained. By July 2008, copper briefly exceeded $9,000 per metric ton before the global financial crisis triggered demand destruction. The resolution stage came through 2 mechanisms. First, the 2008 financial crisis reduced industrial demand as construction and manufacturing contracted globally. Second, high copper prices from 2006 through 2008 incentivized mining companies to expand production and open new deposits. According to ICSG data, mine production increased by approximately 2 million metric tons between 2007 and 2012. The market rebalanced, but only after prices had tripled from their 2004 baseline. This case demonstrates several important points. Deficits persisted for years before prices fully adjusted. Inventory drawdown preceded major price movement. When price discovery accelerated, the magnitude surprised many analysts who had relied on historical price ranges, and resolution required either demand reduction or substantial new supply, both of which took considerable time to materialize. Let's examine a second historical validation of this framework, focusing on a different commodity with different demand drivers: palladium from 2015 through 2021. Palladium serves primarily in automotive catalytic converters, making it almost entirely an industrial metal with minimal investment demand. According to Johnson Matthey's Platinum Group Metals reports, global palladium demand exceeded mine supply starting in 2012. However, significant above-ground inventories, particularly Russian state stockpiles accumulated during Soviet-era production, supplied the deficit for several years. Palladium prices remained range-bound between $400 and $800 per ounce from 2012 through 2017. Market analysts assumed Russian inventories would continue flowing to market indefinitely. The inventory recognition stage began emerging around 2016 and 2017. Industry reports from Johnson Matthey and refiners started noting that Russian stockpile sales were declining. Simultaneously, tightening automotive emissions regulations in Europe and China increased palladium loadings per vehicle. The market began recognizing that the structural deficit wasn't resolving. Prices climbed from around $500 per ounce in early 2016 to over $1,000 by September 2017. Price discovery acceleration struck palladium in 2018 through 2020. With Russian inventories depleted and automotive demand continuing to increase due to the shift from diesel to gasoline engines in Europe following the Volkswagen emissions scandal, palladium supply became genuinely constrained. According to Johnson Matthey data, annual deficits during this period ranged from 700,000 to 1.4 million ounces against total annual mine production of only 6 million ounces. Those are deficit rates of 10 to 20%. Prices responded dramatically. Palladium, which had never exceeded $1,100 per ounce in its trading history prior to 2018, surged past $2,000 in early 2020. By February 2020, it briefly exceeded $2,900 per ounce. That represented a nearly six-fold increase from the 2015 baseline of $500. Industrial buyers had no choice but to pay prevailing prices because palladium has no viable substitute in catalytic converters for gasoline engines. The resolution stage for palladium came partially through auto manufacturers developing thrifting technologies that reduced palladium content per vehicle, and partially through the COVID-19 pandemic temporarily reducing auto production. Additionally, some manufacturers began engineering platinum palladium substitution technologies, though this process requires years of testing and regulatory approval. Even with these factors, palladium remained above $2,000 through most of 2021. As of December 2025, it trades around $1,000, still double its 2015 level, despite significant demand destruction and substitution efforts. This case reinforces several framework principles. Industrial metals with limited substitution options experience more severe price dislocations when deficits persist. The magnitude of price movement often exceeds analysts' expectations because market participants anchor to historical price ranges. Resolution requires either technological innovation enabling substitution, demand reduction, or years of high prices incentivizing new supply. And perhaps most importantly, even after resolution, prices often stabilize at levels significantly above pre-deficit baselines. Now we need to examine counter-perspectives before mapping current silver conditions to this framework. Not all commodity analysts agree that persistent deficits automatically lead to dramatic price increases. Some economists argue that price signals quickly incentivize supply response, preventing extended shortages. They point to agricultural commodities where high prices typically bring increased planting the following season. This is a valid consideration. Commodities with short production cycles can rebalance more quickly than those requiring decade-long mine development timelines. Another counter-argument suggests that demand destruction occurs faster than framework proponents anticipate. If silver reaches $100 or $150 per ounce, some analysts argue that industrial consumers would rapidly develop substitution technologies or reduce consumption. They cite historical examples like tin and solder applications, where health regulations and price increases drove widespread substitution to lead-free alternatives. This deserves serious consideration. Industrial demand is price elastic over time, meaning consumption does respond to cost. A third counter-perspective focuses on above-ground stockpiles. Some analysts argue that official inventory data doesn't capture all available supply. Private stockpiles, jewelry that can be melted, and secondary recovery from industrial processes could provide more supply than deficit calculations suggest. This is possible. Transparent commodity markets don't capture all supply sources perfectly. Additionally, some researchers question whether reported deficits are accurate. They note that if true physical shortages existed, we would see more immediate price impacts. The fact that silver traded in a range during years of reported deficits suggests either the deficits are overstated or that hidden supply sources are filling the gap. These counter-arguments have merit and deserve acknowledgement. Markets are complex adaptive systems where multiple variables interact in unpredictable ways. Variables that could alter projected scenarios include faster than expected mine production increases, technological breakthroughs enabling substitution, major demand reduction from economic recession, or discovery that deficit calculations overestimated consumption or underestimated supply. What I'm presenting is pattern-based analysis, identifying conditions that have historically preceded major price adjustments. It's not certainty, it's probability assessment based on precedent. With that context established, let's examine current silver market conditions through the framework lens. I want to emphasize we're comparing current data to historical patterns, not declaring inevitable outcomes. According to the Silver Institute's World Silver Survey published December 18, 2025, global silver demand for 2025 totaled approximately 1.24 billion ounces. Mine production plus recycling supplied approximately 925 million ounces. That represents a deficit of 315 million ounces, or approximately 25% of total supply. Breaking down demand by category reveals the structural nature of the deficit. Industrial applications consumed an estimated 690 million ounces, according to the Silver Institute report. Within industrial demand, photovoltaic solar panels consumed approximately 220 million ounces, representing a 47% increase from 2024 levels. The International Energy Agency's November 2025 report projected solar installation capacity to increase another 35% in 2026 as countries pursue decarbonization mandates. Electronics and electrical applications consumed 180 million ounces. Brazing alloys and solders used 90 million ounces. Automotive applications, particularly in electric vehicle battery systems and charging infrastructure, consumed 40 million ounces according to industry data. These industrial applications have limited substitution options. Silver conducts electricity more efficiently than any other element. In photovoltaic applications, substituting copper reduces panel efficiency by 3 to 4%, which matters significantly in utility-scale installations. In specialized electronics, particularly 5G infrastructure and AI data center applications, silver's unique properties make substitution technically challenging or economically unviable. Investment demand added approximately 300 million ounces according to the Silver Institute. This includes both physical bar and coin demand plus ETF inflows. Jewelry and silverware consumed approximately 150 million ounces. Photography and other traditional uses continued declining, consuming approximately 30 million ounces. On the supply side, mine production totaled approximately 830 million ounces in 2025, according to preliminary data. Recycling contributed approximately 95 million ounces. Some researchers interpret current conditions as exhibiting late-stage inventory recognition characteristics. COMEX registered silver inventories, which represent metal available for immediate delivery against futures contracts, stood at 48 million ounces as of December 27, 2025, according to CME Group data. That compares to over 350 million ounces in registered inventory as recently as March 2020. Open interest in COMEX silver futures represented claims on approximately 1 billion ounces. That creates a paper-to-physical ratio exceeding 20 to 1 in the futures market. Some analysts note this creates conditions where even modest increases in physical delivery demand could stress available supply. Others argue this ratio has existed historically without causing delivery failures, so it doesn't necessarily indicate impending shortage. Additional data points from other sources paint a picture that some analysts find significant. According to Metals Focus research published in November 2025, above-ground silver inventories held in identifiable storage fell by approximately 450 million ounces during 2024 and 2025 combined. These inventories include COMEX and LBMA vaults, government stockpiles, and ETF holdings. If accurate, this represents ongoing drawdown of existing stockpiles to supply the deficit between mine production and consumption. The Shanghai Gold Exchange, which also trades silver, reported premium pricing for physical silver delivery in November and December 2025. According to Bloomberg data from December 20th, Shanghai silver futures traded at premiums of 2 to 4% above London spot prices, suggesting tighter physical availability in Asian markets. Some researchers monitor this indicator because Asia consumes approximately 60% of global industrial silver. Industrial consumers have begun commenting publicly about supply conditions. Canadian Solar, one of the world's largest photovoltaic manufacturers, mentioned in their November quarterly report that securing silver supply agreements for 2026 production had become more challenging compared to prior years. Procurement officers noted longer lead times and reduced willingness from suppliers to lock in fixed-price contracts extending beyond 6 months. This anecdotal evidence aligns with conditions that historically appear during inventory recognition phases. Critically, we cannot know with certainty several key factors. We don't know how much unreported silver exists in private vaults, jewelry, or other forms that could be mobilized if prices rise substantially. We don't know how quickly industrial consumers could reduce consumption or implement substitution if prices doubled or tripled. We don't know whether mine production will increase faster than current projections suggest. We also cannot predict the timing of any potential price adjustment. Our historical cases showed that years could elapse between deficit emergence and price discovery acceleration. Analysts examining similar historical situations have modeled several potential scenarios for silver. I want to emphasize these are possibilities based on past precedent, not guaranteed predictions. In a scenario where conditions develop similarly to the copper case from 2003 through 2008, silver could experience extended price discovery as inventories continue drawing down. If solar deployment accelerates as IEA projects, and if mine supply increases slowly as typical in mining cycles, physical tightness could become more apparent to market participants during 2026. In the copper case, prices roughly tripled over a 4-year deficit period. Applying similar mathematics, if silver's 2024 baseline was approximately $25, tripling would suggest $75. However, silver entered 2025 at $25 and already trades near $70 in early 2026, suggesting accelerated price discovery relative to the deficit timeline. In a scenario resembling palladium's 2015 through 2020 trajectory, where industrial demand has minimal substitution options and inventories become genuinely depleted, price movements could be more dramatic. Palladium increased six-fold from its pre-deficit baseline. Applying that multiple to silver's $25 starting point would mathematically reach $150. Some analysts note that silver has additional demand drivers that palladium lacked, specifically its monetary characteristics and role in investor portfolios during periods of currency concerns. This could amplify price movement beyond purely industrial supply-demand dynamics. Alternatively, divergence could occur through several mechanisms. Major global recession could reduce industrial demand substantially, particularly in solar installation and electronics manufacturing. If automotive and construction sectors contract as they did in 2008 and 2009, silver demand could fall by 100 million ounces or more, reducing or eliminating the structural deficit. Technological breakthroughs could enable substitution. Researchers are exploring alternative materials for photovoltaic applications, though commercialization typically requires years. Faster than expected mine production response could increase supply. High silver prices in 2025 might incentivize mine operators to increase output more quickly than historical patterns suggest. Or the deficit calculations themselves might prove inaccurate. If actual consumption is lower than reported, or if unmeasured supply sources exist, the supply-demand imbalance might be less severe than data suggests. A third possibility involves extended timelines, where adjustment happens gradually rather than acutely. Markets might oscillate between $80 and $120 for years as supply and demand incrementally adjust, never experiencing the dramatic acceleration seen in the palladium case. Historical precedent shows various resolution pathways, depending on variables specific to each situation. For those studying commodity supply-demand dynamics, here's how professional analysts typically structure their ongoing research. They monitor several public data sources that update with varying frequency. The Silver Institute publishes quarterly interim updates and annual comprehensive surveys documenting global supply-demand balances. These reports typically release approximately 6 weeks after quarter end. COMEX warehouse inventory data updates daily and is publicly available through the CME Group website. Analysts tracking this data look for trends in registered versus eligible inventory, as registered represents metal available for immediate delivery. Industry publications like Metals Focus and CPM Group publish detailed silver market reports annually, typically in the second quarter. These provide granular breakdowns of industrial consumption by specific application. The International Energy Agency publishes quarterly renewable energy market updates that include projections for solar deployment, which directly impacts silver consumption forecasts. Corporate filings from major mining companies provide supply-side information. Companies like Pan American Silver, Hecla Mining, and Fresnillo publish quarterly production reports and annual reserve updates. Analysts studying these documents can assess whether mine supply is responding to current prices. Researchers focused on demand trends typically examine corporate filings and industry reports from solar manufacturers like First Solar, Canadian Solar, and Jinko Solar. These companies' procurement commentary and production guidance provide real-time demand indicators. Those wanting to study these topics further can access historical case studies through academic resources. The International Copper Study Group maintains archives documenting the copper deficit period from 2003 through 2011. Johnson Matthey's historical platinum group metals reports provide detailed documentation of the palladium deficit and price response from 2015 through 21. I want to reiterate that this framework is for educational research purposes only. My role is documenting historical patterns and presenting analysis based on publicly available data, not advising individual financial actions. Anyone considering investment decisions should consult licensed financial professionals who can assess individual circumstances, risk tolerance, and objectives. We've examined a documented analytical framework that appears across multiple commodity cycles spanning decades. We've applied that framework to two detailed historical cases: copper from 2003 through 2011 and palladium from 2015 through 21. We've reviewed current silver market conditions as documented by industry research organizations and exchange data, and we've explored multiple scenario possibilities ranging from dramatic price discovery to gradual adjustment to demand destruction preventing major moves. Key observations from this analysis include several points worth restating. Physical deficits can persist for years before prices fully adjust, as we saw in both historical cases. Inventory depletion precedes major price discovery, and exchange warehouse data provides observable indicators of this process. When supply becomes genuinely constrained relative to industrial demand, price movements can exceed ranges that market participants considered plausible based on historical precedent. Resolution requires either significant demand reduction, technological substitution, years of elevated prices incentivizing new production, or some combination of these factors. And perhaps most critically, markets remain inherently unpredictable. Variables we cannot foresee, technological breakthroughs, policy changes, macroeconomic shocks, or black swan events can alter trajectories dramatically. Critical acknowledgements remain essential. We're examining patterns, not certainties. Past precedent doesn't guarantee future outcomes. Multiple scenarios remain possible, including ones where prices don't reach the level some analysts project. Timing is inherently uncertain. If supply-demand imbalances do result in price discovery, it could unfold over months or years. And markets are complex systems where countless variables interact in ways that defy simple prediction. My purpose is documenting observable patterns from commodity market history and facilitating informed analysis, not predicting specific future prices or providing investment guidance. What's your perspective on the supply-demand framework we've examined? Do you see parallels between current silver conditions and the historical cases? Or do you think the differences are more significant than the similarities? What counter-arguments do you find most compelling? I'm particularly interested in hearing from viewers who work in solar manufacturing, electronics production, or precious metal supply chains. Your direct industry experience adds valuable perspective to these discussions. Let me know your thoughts in the comments. I read every response and often learn as much from your insights as I hope you gain from this analysis. Thank you for engaging with this commodity market research. Stay curious, stay informed, and remember to consult qualified professionals before making any financial decisions.